Hey, what's up everybody? It's Friday. Yeah. So earlier today we had another very emotional, scary, panicky reaction in the stock market. Oh, Trump put the tariffs on. Market was down 300, the Dow was down 300, S&P. I sent out an email to my subscribers to buy the dip under yesterday's low. Yesterday's low was 28.36 on the S&P. I think we got down around 28.30. We bought at the bottom. We have been scale buying down into this dip. All right. All this stuff is going to fade away. I'm telling you right now. If you look at the fiscal support that we are experiencing, it is unprecedented. Unprecedented. I just sent out a thing earlier. We are up 218 billion over last year already. You know, at this time last year, remember last year spending hit a record. At this time last year we were up something like 75 billion and we were growing at about 2.5% year over year. The growth rate of spending I'm talking about. This year, right now, we are up 218 billion over last year. And the growth rate of spending is 7.5%. I have never seen that rapid a pace of spending growth. That is really, really astonishing. That is the tide that floats all boats. I'm telling you, that is the main underlying fundamental. I mean, at that rate, the economy in the second quarter can expand at maybe 4%, maybe over 4%. And I laugh, like yesterday, the other day, we had once again the yield curve flip to an inverted, situation. And you had all those inverted yield curve recession prognosticators come crawling out of the woodwork and say, oh, we're going to have a recession because the yield curve is inverted. Folks, you do not understand it. This is massive, massive fiscal support. We had, who else? Oh, Jeffrey Gundlach. He was out there. He was talking about, oh, it's a bear market, a bear market. I'm telling you. Right now, as I've mentioned in past, the last couple of videos, you got two things going on here. The first thing was this reserve build, bank reserve build. I've explained that, in April. And this happens with regularity. You get reserves going into the banking system from government spending. You get reserves coming out of the banking system from taxation. And these things have an effect on banks and the way they manage their assets. And that has an effect on the market. So now we're back in this swing where reserves are building back into the banking system because all that money the government took in taxes in April, it's now starting to spend it back out to pay the bills. The money flows back into bank balance sheets. So that some of their buying of securities starts to slow down. It acts as a drag on asset accumulation, asset creation. Doesn't stop it, it doesn't turn it down, but it slows it down a little bit. So we had that already was about to happen. It was happening. That was late April, early May, when that effect was starting to hit. That caused the top in the market. And then on last Sunday, Trump comes out, hey, I'm going to put the tariffs out and surprise everybody. So you had already this kind of braking effect from the reserve flows, and then everyone got panicked and spooked about the tariffs. So yeah, this is normal what's happening. But you have to know when that flow situation starts to reverse. And I track this. This is absolutely tradable for those who know. And you know who knows? I mean, besides me and my people, you know who knows? Zero. Nobody else knows. So we know how to trade this. When this stuff clears up, boom, we go to new all-time highs. And right now, it's kind of interesting and it's kind of funny, actually, because everybody's saying, oh, the Fed's going to have to cut rates because the tariffs and this and that. Let me just go out on a limb and tell you that as long as Powell can hold his hand off the trigger, keep his finger off the trigger for the next couple of weeks, then the thing he's going to start talking about, and the thing that other Fed officials are going to start talking about down the road, another month or couple of months down the road, is asset prices are getting too high and they want to calm it down. And that means more rate hikes. So that's what's going to happen. I'm telling you. The only thing we have to worry about, and I doubt it's even a worry, is the 2020 budget, the new budget for fiscal year 2020. We won't get that till the end of September. October 1st is the deadline. By then, the deficit's going to be near $1 trillion, maybe slightly over. So all these crazy deficit hawks are going to be going, oh my God, the deficit, we're going to have to cut spending. That's when we have to see what they're going to do. But most of the spending is non-discretionary. And I would lump defense spending into that as long as Trump is the president, because he treats that as a non-discretionary spending item. So when you have Social Security, Medicare, Medicaid, and defense, all non-discretionary, you're talking about 3/4 of all spending right there. So there's not much they can cut after that. So basically spending is going to stay the same. So we're looking good. We're looking very good. Now if you want to get on board, if you want to understand all these things, if you want to have knowledge, if you want to have some sophistication, if you want to have information, if you want to know what to look at, if you want to understand what moves these markets, got to sign up. Come to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. Stay out of the dark. Come into the light. Have a great weekend. Bye-bye.